Bankers often refer to debt consolidation loans as the never-never plan. Well, so what? Aren't debt consolidation loans good because they lower the interest rate that you're paying? Ted and I discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Okay, Ted, welcome back. Let's start with a definition. What is a debt consolidation loan?
Well, that's an easy one. It's where you get one large loan to pay off all your other debts.
Thanks for coming out, people.
I guess we're done.
That was a really easy show. So, okay, we're going to get to the point here, but why would someone get a debt consolidation loan?
Well, so the premise is that if you've got a bunch of credit cards and other debts, the interest rates are much higher than they would be on a simple bank loan. So you get the consolidation loan, so you get a lower interest rate, thereby reducing your total monthly payment. So it improves your cash flow, improves the expenses that you're paying for borrowing somebody else's money. That's the theory.
Yeah, and that kind of makes sense. And we've seen a lot of this since the whole, pandemic period, where for a couple of years there were people who had to rely on credit cards and things like that. Now they got a bit more debt, so they go back to the bank and say, "Hey, I'd like to consolidate it, so I've got one monthly payment." So I'm going to give you a case study here.
Case study, great.
I just made this up, but
okay.
It's kind of reasonable.
I'm surprised they have cards this week.
I know. You really don't need them, but I felt it would look better if you actually had them. Okay, here's a guy. He's got 4 credit cards.
Mm-hmm.
They total $20,000 in total.
Yeah.
The interest rate, 19.9%. Let's call it 20%.
So they're not horrible cards.
No, they're your typical basic Bob, regular kind of credit card. So I guess if you do the math, that would be $333 a month in interest. If you have to make a 2% payment each month towards principal, then that'd be around $700-800 a month, whatever that is that he's got to pay.
Right.
So a lot of credit cards, it's $15 minimum or 2% of the outstanding balance. So if you were just paying the minimum, according to the calculator I looked at, 91 years to pay it off.
Right. Isn't that what they added to credit card bills about 4 years ago? And nobody
Yeah.
reads that part now because it just scares them.
Yeah. And we always look at it when we're meeting with someone and say, you see how it says 91 years?
Right. You'll be dead.
So I will put a link in the show notes to the Government of Canada credit card payment calculator so you can punch in the numbers and verify that what I'm saying is correct. So if in fact it was going to take you 91 years to pay it off, then you're going to be paying like $97,000 in interest on your $20,000 credit card.
Wow.
Now that's stupid because you probably won't be alive in 97 years, or 91 years. But anyways.
Okay.
So that's now if it was a consolidation loan instead of these credit cards, and let's say, over 3 years, you're going to pay it off.
Yep.
What kind of numbers we would be looking at then?
Well, so pick an interest rate, let's say 9%. Your payment's going to be $635 a month.
So over the life of the 3 years, you're paying like $3,000 in interest.
Right.
That's a lot better than.
Well, and if there's not a big enough payment difference for you, then amortize it over 5 years, and that payment's going to drop, but your interest is going to go up.
Right. So why then, when you go into the bank and you say, hey, I got these 4 credit cards and they're all, 20%, and I'd like to consolidate. So bank, I'd like you to give me a loan where the interest rate is 9%. Why would they do that?
Well, so I'm going to assume that one of those credit cards in your case study probably was from the bank you're trying to get the loan from. That means the other 3 aren't. Well, so they're not making any money on those debts. So by giving you a consolidation loan, they've now stolen all of that business from their competitors, and they're getting interest on the full $20,000 instead of probably they were getting $5,000 worth on the interest for the card you had with them.
So you're saying banks are in this to make money?
Well, they better be. I have, that stock in my retirement plan.
There you go. Okay, so that kind of makes sense that even though they're going to lose a little bit of money on the interest rate they're charging you on the credit card you've got with them, they're taking work from other banks, so they're getting money. Okay, so this all sounds fantastic. So right. I've got 1 monthly payment instead of 4. I can stretch the amortization out. The interest rate is lower. So what's the problem here?
Well, so in most cases, by the time you get to the point where you need a consolidation loan, you probably won't qualify. I mean, the banks want to get that extra business. They want to lend you money if they're confident you can pay them back. But if you've got a bunch of credit card debt and any kind of delinquencies, so you've been missing payments, they go, well, wait a minute. I'm not sure that you have the right ratios for us to give you this 9% loan. Maybe we'll give it to you at 15%. So it's not such a great deal. Or maybe you got to get a co-signer, somebody to help you with the security on the loan.
And so that's what will increase my chances of getting the loan then.
That's right.
A cosigner. What else? What else can I do to convince the bank to give me this loan?
If you have some sort of collateral. So, I mean, the most common one is if you need a consolidation loan is they'll say, well, we're happy to give you a second mortgage on your house. And so now you've taken these credit cards that if you default on, somebody has to sue you. And you've said, well, I'll get a much lower interest rate, but if I don't pay the bills, they're going to come take my house from me.
So you're talking about a HELOC there.
HELOC is one possibility, or simply a second mortgage.
And we've talked about this before.
HELOC folks are a home equity line of credit.
Right, a home equity line of credit, which is a line of credit that is secured by your home. So the bank will therefore give you a lower interest rate because their risk is really low.
Right.
Because if you don't pay, they can take your house.
Yep.
What's the downside to me doing that then?
Well, there really only is a downside if you can't make the payments. Now your house is at risk. Or if the real estate market corrects like it's doing right now.
Yeah. Yes, we are recording this in the fall of 2022, and real estate prices are going down. We talked about that a couple of weeks ago with Ron Butler on the
interest rates are going up. It's just it's a perfect storm.
Yeah, and so I get this home equity line of credit or just a regular line of credit, and if it's a variable rate, I go, okay, this was great. I had these credit cards and I was paying $700 or $800 a month. Now I only have to pay $300 or $400. Well, but that might become $500 or $600 going forward. So you may have some issues. So, okay, so I can increase my chance of qualifying by having a cosigner or having security. Right. And again, this all sounds good. So why did I make the title of this podcast the Never Never Plan? What am I getting at there?
Well, so the issue is all of this, what we've just described is a situation where your payments are lower, your interest costs are lower, and you can see a light at the end of the tunnel. What happens with most people, though, is they're allowed to keep at least one credit card. Often they keep 2 or 3, or they apply for new ones after they've got this debt consolidated, and so now they've doubled down. So now they owe more than they started in the first place, and the debts just never get paid off. You just keep rolling it forward. I mean, the second mortgages and the HELOCs are probably the worst example of that. So as long as the value of your house keeps going up, they'll keep extending you credit, so there's no impetus on your part to get out of debt. So you just keep carrying this forward because it's a monthly payment that you make. So the Never Never Plan is you are never, never, never out of debt.
And so have you ever had a client come in that situation?
Not today, but yesterday, the day before that, the day before that.
A very common situation.
Right.
So they had all the best of intentions.
Right.
Like this makes perfect sense. And in a lot of cases, it's actually the lender reaching out to them.
And these days it certainly is. I mean, anyone listening has probably had at least one message on their cell phone voicemail or their answering machine at home, if you still have one. It's the bank calling. Well, we noticed that you could utilize some more credit. We're going to increase your limit or whatever they're going to do.
Well, I've got a couple of bank accounts at 2 different banks. One I use for most things, but I got another one just as a backup. And so I logged into that account the other day just to, see how my $20 is doing.
Right.
And it flashed right on the screen, hey,
pre-qualified?
Mr. Hall, pre-qualified for, I think it was a $10,000 credit card,
right? Which
is not a consolidation loan.
Nope.
But, and my credit score is pretty good, so I guess I probably qualify for it. So that's the bank's business model right there.
Sure.
And now I've also seen the offers where here you qualify for a loan, but so is it typical for the bank to say you have to cancel all your other cards, or is that atypical?
They'll probably tell you to cancel all of the competitors' cards, but there's no restriction on you applying for new ones. So again, the example that we see most often is you pay off all of those other debts. You're down to one credit card, which you should be using just for convenience, not for credit purposes. But within 6 months, unless you've changed your spending patterns, you've probably applied for 2, 3, 4 new ones, because they're going to be made available to you, because how those other companies make their money.
Well, and if we think this through, so in my case study, I had a guy, could have been a girl,
a person
who had 4 credit cards. Right. They go and they consolidate them. Now, with a debt consolidation loan, your total debt doesn't change.
Right.
I owed $20,000 on 4 credit cards. Now I owe $20,000 on a line of credit or a loan or whatever it is I got.
Correct.
So if I then go and apply for a new credit card, I'm increasing my total debt.
Correct.
Why would the bank give me that new credit card? I guess part of the reason is because I've now lowered my utilization.
Well, the simplest reason, I used to have a credit card with Bank A and it was paid off in the consolidation. So they saw that you handled your card properly. You paid it off. Why wouldn't they give you a new one?
So your credit score, your ability to borrow can actually go up when you get a consolidation loan.
Yeah, I'm not sure we should be telling people that, but it's true.
It's true. And again, I'm thinking this through both from the borrower's point of view, but also from the bank's point of view.
Right.
So if you've got 4 credit cards and they're $5,000 limits and they're all maxed out,
right,
then you've got a high utilization that's going to reduce your credit score.
Correct.
Now, if you've got a good enough job and you're able to qualify for a consolidation loan, well, now, even if you don't cancel those other cards,
right,
you've now dropped the utilization down to 0.
On those cards,
Yep. Which even though your debt level is the same, that may very well increase your credit score.
True.
Which is why you can then go to a new bank and borrow more.
Just the act of paying off those cards will have a positive impact on your credit score.
Right. And the credit score does not calculate utilization on a loan,
right? Because
that's not a thing. Utilization is on a revolving.
All the loan
line.
Just says, yeah, your high balance was this, your current balance is this, you're making your payments.
And so it's all good. So, okay, so that's why with a consolidation loan, you can end up still being able to borrow more money.
Yep.
And that's the biggest problem. I mean, that's why we're calling this episode the Never Never Plan. You
Right.
end up just continuing. You never get out of debt.
Well, you double down. That's what most people end up doing.
So the bank doesn't want you to get out of debt.
No, it's not in the bank's interest. The bank's interest, I shouldn't be using that word. The bank is biased towards making sure you carry as much debt as you can afford to repay, and not $1 less.
There you go. Because that's how they maximize their profits.
That's right.
Okay, cool. So that's the background to all this. Let's talk about practical advice then.
Mm-hmm.
So whoever's listening or watching to us today, and I'm sure if you're watching on YouTube, you've already hit the button, right? You know all those buttons, the like and the subscribe and the notification and the whatever. Okay, so what advice do you give someone who is contemplating getting a consolidation loan? What are the things that pop into your head?
Well, so keep in mind, there's no such thing as having a bank as your friend. Banks are not your friends. Banks are in business to make money. And so if they're going to approve you for this consolidation loan, it's because they think they can make money off the transaction. It's as simple as that.
And what you just described, they want, you said, to get you to borrow as much as you can borrow, but not a penny more.
And they want you to borrow it all from them.
So they want you in the Goldilocks zone, right? It's not too hot, not too cold, just right.
Yeah. We're both of an age that personal lines of credit really became popular, I want to say, just around the turn of the century.
I'm 35 years old. I don't know what you're talking about, but okay, fine.
Metric, double it.
Yes, exactly. Dog years, yeah.
So it used to be you'd have credit cards, and then all these personal lines of credit came along, and people would get those, pay off the credit cards because they were lower interest rates. So it's all, I mean, it's the reason that the banks like giving you lines of credit is because anytime you need money, you just automatically tap into the line of credit. You don't go shopping anywhere else. So it was all part of this branding, getting you to stick with the bank.
Yeah, and that makes sense because if I get a loan and it's got fixed terms of repayment and 5 years later it's paid off, if I want more money, I got to go back and requalify, and there's a lot of work for the bank.
And you might go shopping elsewhere.
Yeah, because I got this offer for this other place that has a better rate, and so I go there. Whereas if I have a line of credit, well, I pay it off, I can borrow tomorrow. It's perfect.
Yeah. But back to what we were talking about, practical advice for if you get this consolidation loan. So you've been approved, you pay off the credit cards. Make sure if the bank doesn't ask you to, you cancel the card yourself. Keep one, maybe $1,000 limit if you need something for convenience, not for credit purposes. I mean, you used to be famous for saying credit is not a replacement for cash.
I'm still famous for that.
I haven't heard you say it in a long time.
Credit is a substitute for a credit card should be a substitute for cash, not a way to borrow.
Right. There you go.
And so you have to evaluate your own situation. So is $1,000 limit the right number? I don't know. I mean, if you travel a lot and you're always booking hotel rooms, okay, $1,000 probably isn't enough.
Right.
But you probably don't need a $50,000 limit either.
Well, and if you travel a lot for business or have other expenses you've got to pay and then you get reimbursed for, I would say that's a good example of when you should have 2 credit cards. One that you know you're going to be reimbursed for. It's very clean. You can always show it to the company. And the second is the one you use personally for groceries, gas. You know you're going to pay it off when you get paid in 2 weeks.
Yep, and that's exactly what I do. I've got the business version and the personal version. So we don't want to give advice that's so specific that it's wrong in your situation.
Right.
I think you got to look at your own situation and go, okay, how many credit cards do I really need? And I get it. I want to put as much on my credit card as possible because I get points. So instead of using my debit card, I use my credit card. That's fine.
Right.
Because like you said, I'm paying it off regularly. Yep. So I pay my credit card off every week. Because
you have to.
Well, yeah.
We use it for business
We use it
purposes.
for business, and I don't want to have a massive limit, so I just go on every week and pay it, and I'm always good.
Right.
So I don't need to have a massive limit, but I understand that, okay, there may be reasons why you need to do that. Now, on your point about canceling your credit cards when you get the consolidation loan, I agree with that because you can't get into any trouble if it's been canceled.
Right.
Now, bear in mind that if longer term, so let's say 3 years from now, I'm buying a house.
Right.
And so I want to qualify for the best mortgage rate I possibly can. From a credit score point of view, well, the more credit you have access to and the lower your utilization rate, the higher your score is going to be. And your credit score is based on history.
Right.
So if you've had a credit card for 5 years, that gives you more points than if you only had it for a year. So you got to balance those two things. I still side with you. The fewer cards you've got, the lower the limits you got, the better.
You can't get into trouble if you don't have access to credit in the first place.
Exactly. And if you've got a consolidation loan, then that's going to support your credit score. And if you're saving money for a down payment, well, the bigger the down payment you got, the less of an issue it is.
Right.
However, consider, in your own situation, how many credit cards is the right number? Maybe you keep the one that's oldest because that's supporting your credit score the most. Or maybe you just say, I don't need to live on debt and get rid of them. That would certainly work. So, okay, so back to practical advice then. Right. So you've said that, number one, the bank is there to make money off you. Right. So they're not your friend. And you've said number two, get rid of, if you consolidate,
any excess credit cards.
Cancel any excess credit cards. Okay, what other practical advice can you give people?
Well, so you have to think of a consolidation loan as a, once in a blue moon, once in a lifetime kind of event. Your financial planning shouldn't be every 5 years I'm going to get a consolidation loan. I mean, that just doesn't make any sense.
Because you're paying more in interest.
Right. Well, and it means your lifestyle isn't reflecting your actual income. So if you have to accumulate debt every 5 years and then deal with it again, it's just you're doing something wrong. And
again, we understand, particularly over the last 3 years, a lot of stuff has happened.
Yeah, a lot nobody could have predicted.
Nobody could have predicted it. We certainly didn't. It's going to be a fun year-end prediction show to see how we did. Tune in at the end of December to see how we did on our predictions this year. Not well, I think, is the answer. But yeah, a lot of stuff happened that wasn't foreseeable.
Right.
And a lot of people ended up having to incur debt. And now that they're back to work, things are moving again. Great. I can now consolidate and clean that up. I then have to take the next step, as you say, and go, okay, I don't want to be having to consolidate again.
Right.
Let's see if I can start tucking some money away so that for the next event I've got
what
some
do
cash
I do differently going forward? That's really what that comes down to.
Now that I've been through this kind of crisis, what can I do to anticipate? And maybe you can't. Maybe there's nothing you can do, but you actually want to think about it. So,
well, and that kind of leads into the next point. Does the consolidation loan actually solve your problem, or is there an underlying issue that still has to be addressed? So if you accumulated all of this debt because something's gone wrong in the last couple of years, and it doesn't look like things are going to go wrong in the future, okay, so maybe things are all right. If you accumulated all this debt because you regularly spend more than you earn, your expenses are just out of line with your income, then the consolidation loan has bought you time, but it hasn't solved the underlying problem. Yeah, you're going to be in debt again.
You've kicked the can down the road.
Right.
And again, we get it. We're in a period of inflation right now. Costs are high. Incomes are not going up as fast as inflation. So a lot of people have to either dip into savings or dip into credit to survive. Yep. But that is not a long-term strategy. So, okay, when I'm looking at this, then what are my other options then? I mean, obviously on the income side, well, I got to try to get another job or whatever. Like, what can I do to avoid either the consolidation loan I'm talking about or one in the future?
Right. So if you need money, there are really only a couple of ways to get it. One is, have you got something that you can sell? And for most people, I guess that would be their house, which that's a tough family decision to make. But if you've got assets that can be sold, converted into cash to pay down debt, you're not paying any new interest because you're not borrowing, you're just paying debt down. The other option, of course, is either try to increase your income or decrease your expenses. It's difficult to do both. To increase your income overnight basically means you got to go out and get a second job. And long term, that's probably not sustainable because you'll just work yourself into a grave. And if all you're doing is working to pay the bills, then what's the point, right?
Yeah, exactly. So if you're right, if it's a short-term thing that, okay, I need to, whack $5,000 against my debts. So what I'm going to do for the next 6 months is I'm going to pick up a job on Saturdays.
Yep.
I'm going to work at the coffee shop. I'm going to get some overtime, whatever. And I'm just going to focus on that. I think if it is a short-term thing, a number of months, okay, then that's doable.
Right.
If it's for the rest of my life, I'm going to have to work 7 days a week, then it's not sustainable.
Right.
So you got to look at the reducing expenses side of things, which is also difficult to do.
Yeah. I mean, your changing expenses usually take some kind of long-term plan. Your rent or your mortgage is what it is. You have no control over that except for to move to someplace else. If you got a car payment, it's the same sort of thing. I mean, the expenses that are, what's the word we're looking for? Variable, flexible, are things like, well, how often do I stop for coffee on the way to work? Can I change the way I buy groceries? Maybe I don't need 5 streaming services. I can get by with 2, that sort of stuff. You take a look at how you're spending your money and assess, well, is that more important than reducing my debt?
Yeah, you can watch this podcast for free, so you don't even need a streaming service. Yeah, and it's one of the biggest expense people have is their rent or their mortgage. The second biggest expense typically is a vehicle,
right? Because
you've got a car payment, but you've also got gas and insurance and all the rest of it. And the only solution there is, well, is it possible to move closer to work or to live in a place where I can take public transit?
Yep.
So, because, I mean, you and I have seen tons of people over the years who get paid twice a month, and one of the paychecks goes towards the car.
Right. And the other one goes for the rent.
Right.
So they better be in a relationship where somebody can buy the food.
Yeah, it's really difficult. So, But that's not the thing you can do instantly.
Right.
I got to find a new place to live. I still got 3 years on the car loan, whatever. So a lot of these things have to be looked at in advance. So okay, increase your income, reduce your expenses, easier said than done. Now you talked about assets. So, okay, selling your house, but then I don't have a place to live.
Right.
But yes, that might be an answer for, in a lot of cases, particularly if the real estate market is going to be going down for a while. Well,
better to sell now to make some money.
Exactly. Assuming you can find a place to rent, which is not easy.
Right.
What other kind of assets would people have that, I mean, okay, if I've got a second car, maybe I sell that, but what else could I have kicking around that potentially could be turned into cash?
You might have a tax-free savings account, although most of the people that are in these kind of scenarios put the money in and then take it out again next month. It's not a long-term savings plan. Most common one people have is an RSP, and there are pluses and minuses to cashing that out. So maybe we should talk about that for a minute.
Yeah. So, and you may even have an RSP through work.
Right.
So it's like, okay, it's there and I put the money in and maybe the company kicks some money in as well. So taking the money out of the RSP is good because now I've got money to pay down my debt. I'm not paying any interest, but there's a downside to that.
Right. Usually when you take money out of a company RSP plan, you become ineligible for matching funds for a period of time. When you withdraw money from an RSP, you get taxed. If it's under $5,000, it's 15%. Well, if you're in a 25 or 30% tax bracket already, you take $5,000 out of your RSP, you pay the 15%, that's $750. Next spring, when the tax bill comes around, you should have paid $1,250. You get $500 tax bill suddenly. You got to plan for this stuff too.
And you can go on Revenue Canada's website. I think it's like 10% if it's below 5,000 and 15%. And if it's the point though is it's almost for sure not the exact tax bracket you're in.
It's almost never enough.
And it's almost never enough because they're taking it off at potentially the lowest tax bracket. And so you and I have seen this all the time. Someone says, okay, I'm going to take out $2,000 a month for my RSP. So I'm only getting the withholding at the small number. But of course, when I file my taxes at the end of the year, I've now increased I put myself in a higher tax bracket.
Well, and the other cost is you don't get the contribution room back. So the whole idea with RSPs is you're saving for tomorrow. So they're protected under certain types of laws. It's hard to get for creditors or anyone else to get money out of your RSP. So if you take it out, you're stealing from tomorrow. That's the short answer.
Yeah. And so, okay, I guess if I've got a high interest loan at one of these lenders that charges 45%, then taking the money out of my RSP and having to pay a little bit of extra tax maybe saves me quite a bit over the next 3 years, and it's a good deal.
Right.
But you got to consider that very carefully, because you're right, that contribution room is now gone and you're getting hit with a tax bill. So, okay, so what can you do on expenses? What can you do on assets? Now, let's say you've gone through all that and, okay, you know what? The numbers just don't work. I can't consolidate enough. It just doesn't work. So, of course, everybody listening knows what you're going to say next.
Right. You should be considering a consumer proposal.
Right. So let's do a case study on that then.
Okay.
Same facts as we had before, $20,000 in credit card debt. So as I said, the minimum payments over 91 years are $97,000 in interest. And as I said, that's a stupid example because no one's going to be paying for 91 years. A more likely scenario might be, okay, I'm going to pay $500 over 5 years. So that's, $30,000 to pay off my $20,000 in credit cards. That's still $10,000 in interest, but it's not, it's bad, but not horrific. Or I could get a consolidation loan. Mm-hmm. And again, $650 a month, $3,000 in interest over 3 years. If you do it over a longer period, the interest is higher. So what would potentially a consumer proposal look like in the same scenario where someone's got around $20,000 in debt?
Yeah, well, so keep in mind the consumer proposal needs to include all of your debts, your credit cards, your payday loans, your overdraft, all that sort of stuff. So we're going to focus on this $20,000, but you can't just pick and choose which ones you want to do. It's got to be everybody. Normally, you offer to repay about a third of what you owe or more money than your creditors would get if you were filing an assignment in bankruptcy. Now, the bankruptcy calculation is a little more calculated. I don't know that we want to get into that today.
No, and we've talked about it before. If you go bankrupt, you have to pay a portion of your income. You lose some of your assets. It depends if you've been bankrupt before or not and whatnot. So let's say in this particular case, we did all that math and a bankruptcy was going to cost, $3,000, $4,000, $5,000.
Right. Well, so a third of $20,000, you probably got offered to pay between $6,000 and $7,000 back to your creditors. Do that over 5 years, you're looking at a payment between $100, $120 a month.
So that's a lot less than
$635 or even the $500.
Yeah. So
and there's no interest.
So, and of course you can pay that off quicker. So if you actually can't afford to pay $200 a month, then it's a $100 a month proposal. Well, you get it paid off in 2.5 years instead of 5.
Right.
So that sounds great. It's cheaper. There's no interest. What's the downside to that?
Well, so you're going to take a hit on your credit report because you're not actually paying back the debts in full and they're not making any interest off you. So the offset is, am I saving enough money by reducing the repayment and the removal of the interest that all of that makes sense? Usually it does. I mean, one of the advantages of a proposal is not something that people usually think of, but when you get the consolidation loan, even if you cancel the credit cards, you can go out and apply for new ones because your credit looks better. You file the proposal, you're probably going to be restricted from any kind of access to new credit while you're making the payments, and that will force you to handle your money in a different way. In my opinion, that's a good thing. You stop relying on credit.
Right. So if you're filing a consumer proposal, it's like, well, from this point on, I'm using a debit card and I'm using cash.
That's right.
And it is possible to get a secured credit card or a small unsecured credit card while you're in a proposal, but you're not going to have, $20,000 worth of available credit while you're in a proposal.
Right.
But you also shouldn't need it because you're not paying $635 a month on your debts.
That's right. I mean, if you had that second job because you were trying to make all those payments, maybe you file a proposal, you don't need it anymore, right? I mean, there are all sorts of, depending on your situation, all sorts of advantages that aren't as straightforward as just you're paying less. There's more to it than that.
Yep. And I've got a number of clients who said, you know what, I'm going to keep that second job for the next 6 months, even though I filed a proposal.
Yep. Because
now I can get ahead on the proposal payments, put a bit of money into savings,
right,
and then I'm in a much better situation. So bottom line is when you are considering consolidating, I'm a big believer in talking to an expert.
Yep.
Obviously, the bank wants to sell you what they want to sell you, so fine, talk to them. That's cool. But I think if you also talk to a licensed insolvency trustee, we can say, well, here's what a proposal would look like.
Look at all your options. If you're going out for a car, you wouldn't just buy the first one you saw.
I do, actually. But 12 years ago when I bought a car, that's exactly what I did. But yes, I get your point. You should do a little research, do a little shopping around. And you want to understand the pros and cons of each. Right. So a lot of people who come into us, we say, no, you don't need to file a proposal. Right. That's not the right option. You should be doing this or that. But for a number of people, that's the correct option. Great. Then that's what you should do.
Correct.
So there you go. The never, never plan. the banks want you to get the consolidation loan.
I didn't make one single Peter Pan reference.
No, that was good.
I guess I just did.
We just did. So
yes.
The bank wants you to get the loan if you qualify. If you don't qualify, forget it. And we're seeing fewer and fewer people qualifying now as interest rates are higher, debt service ratios are higher, and so on.
Right.
But they also want you to still have access to a little bit of credit just so that they can keep you up at the level they want. So beware of that. Not to say the proposal is the perfect answer for everybody. That's why you got to consider all your options. Ted, thank you very much for being here. That is our show for today. So as I said, I'm going to put links in the show notes on YouTube to the Government of Canada credit card payment calculator. We've also got a Michalos debt payment calculator that goes through some of these scenarios as well. So if you want to run the numbers for yourself, they're all there. If you are watching on YouTube, like, subscribe, leave a comment. Always happy to hear what you say. And if you are listening on one of the famous podcast apps, you're a big podcast app guy, aren't you, Ted?
Sure I am.
He has no clue. So Spotify, Apple Podcasts, Google, they're all there. You search for Debt Free in 30. You can subscribe. New show every week. There will be a new show next week. Until then, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.